add one of the kids to your house and lose your house. My name is Philip Bruce. I'm a Minnesota estate planning attorney, and frequently during planning meetings, we'll have folks who will suggest, and they're correct, that if they add one of the kids to their house, that house will go to them directly at death and not have to go through probate. As long as it's joint tenants with right of survivorship, as long as you own it joint tenants, that is an accurate statement. If I die and I've named my daughter as owning the house as a joint tenant with me, she will get the house probate free. But there's three things that cause problems here, which is why we never recommend this. It's actually true. This used to be a pretty common estate planning technique to avoid probate. It's just fallen out of favor because of this. First off, I have homestead protections on my home. If I own a house and I live there, if someone sues me, if I declare bankruptcy, if I have some problems with creditors, they can't take my house. It's protected. It's my homestead. If I add someone onto my house who doesn't live there, well, they don't enjoy that same homestead protection. So if they get sued, and let's not get into divorce, that's a separate issue. If they get sued, if they declare bankruptcy, well, as far as the court system is concerned, this is just a rental house for them. So now I've lost my house potentially. That's very, very scary for many people. But there's two other reasons, and they're both tax, so buckle up. I'll try to make this straightforward. If I buy my house and then I sell it for more money, I don't have to pay capital gains because it's my house. I lived there for 2 of the past 5 years. Okay? That is not the case for somebody who I've given the house to. They don't live there. They don't get the homestead a tax break. Okay? Not only that, but my basis, my cost basis in the house, my purchase price for the house, when I make a lifetime gift of any appreciated asset, it can be stock or mutual funds or a house, if I make that gift during life, when it's sold, whether I'm alive or not, the person is going to take that purchase price, they're going to take the price they sold it for, and they're going to pay tax, capital gains tax on that difference. People who live in a house are exempt from that. People who make after-death gifts are also exempt from that. If I just gave the kids my house after death, all the capital gains gets wiped away. It's those lifetime gifts that cause a problem. And when you're giving someone a joint interest in your house, you're giving them a lifetime interest. This is a little bit higher than how I usually speak with these videos, but the last thing I'll mention is it's a gift. We know that there's gift tax out there on the federal level. There's an exemption amount. It used to be $10,000, then it was $12,000, then it was $14,000, then $15,000. It changes every year. But I can gift up to this dollar amount per year per person. If I have a $200,000 house and I give someone half my house, I've given them $100,000. You're probably not going to pay any tax because there's this whole other exemption called a lifetime exemption, but you do have to report the gift, and you have to be very careful of that. So those are three things we watch out for when we're talking about giving someone half the house. I really never recommend that. There are better solutions. Any questions, please do shoot me an email.